Keeping perspective, helpful reminders for long-term investors during times of change. I'm Brian Perry, Executive Vice President, Chief Investment Officer here at Pure Financial Advisors, coming to you today to talk about some of the common questions we've been getting from people regarding what's going on in the world. And anytime that there's a change of administration or a change in the external environment, natural questions come up around, is it the time to change up some of your financial approach, or should you stick with your long-term approach? And we wanted to address some of the most common instances of that we've been getting, starting with the question of, I'm worried about the future, what should I do? And the bottom line is that the future has always been uncertain. And so picture somebody that's born in 1960. Maybe you were born a little bit before or after that, but somebody born in 1960 during their lifetime saw a global pandemic that shut down the world in 2020. There have been 12 presidents since 1960. Out of those, 1/3 or 4 of them either were assassinated, shot at some point, or forced to resign from office. There were 18% mortgage rates and 0% saving rates, an assault on the U.S. Capitol, multiple wars, the threat of nuclear Armageddon, an election that had to be decided by the Supreme Court, and the end of the gold standard for the U.S. dollar. All of this has happened during many investors' lifetimes. Oh, but by the way, during that time, the Dow Jones Industrial Average started at 600 and today is around 45,000. So despite all of that war, famine, upheaval, etc., all this uncertainty, markets have done just fine. Times have always been uncertain. Markets have always performed given enough time. The next question we've been getting is, what if the market sells? What if it falls off? Well, the reality is that the market often falls. In fact, if you look on average since 1980, the market has fallen 14% each calendar year at some point, right? Despite that, though, in 3/4 of the year, 33 out of 44 years, the market ended the year higher. And so volatility shouldn't be a surprise. It shouldn't be something to worry about. It should be the expectation. Markets will fall. That's one of the only things I can be certain of, is that at some point the market will decline. Then it will rebound. It's like the seasons. Sometimes it's summer, sometimes it's winter. You may or may not like it, but it's part of the deal as a stock investor and speaks to why diversified portfolios for most people with a mix of different asset classes makes sense. But one question we get despite that is, well, if we know the market's going to fall or we have certainty, what if we could tell when it's going to fall? And if you can tell when the market is going to fall, then yes, absolutely, you should probably get out. The problem is that almost nobody knows exactly when the market's going to fall, and the cost of being wrong is extreme. This chart looks at over a 20-year period, 2 decades, what would have happened to $10,000 invested in the S&P 500. And that $10,000 would have turned into $65,000. However, by missing just the 10 best days, so one day every other year of those 2 decades, your return gets cut in half from $65,000 to less than $30,000. On the other hand, if you miss the 60 best days, your return gets cut by 93%. So more than a 90% reduction in your portfolio returns by missing just 3 days each year if your timing is terrible. I know that a lot of people think that their timing might be perfect and they might get out at just the right time, but the reality is that the 10 best days all happened during either the financial crisis or the COVID crisis, the 2 times investors were most likely to be worrying and getting out of the market. So again, timing the market, it's an attractive idea. We understand that, but the timing needs to be perfect or the results can be catastrophic to your financial future. The other question we get a lot is, what about diversification? Artificial intelligence and technology are all the rage, so why don't I just concentrate there? What's the downside of that? And the downside, quite frankly, is if it doesn't work out, you won't meet your financial goals. This chart looks at a variety of different financial markets during the decade of the 2000s. During that decade, the S&P was down on average 1% per year. But all these other indexes, large company value stocks, international stocks, small stocks, were all up anywhere from 4, 7, 13% per year. The asset classes on here are meaningless. It could have been the S&P, it could have been something else. The bottom line is that concentrating in any one asset class might raise the ceiling of your possible returns, but it lowers the floor as well. And for many, many of our clients, the idea of making sure that the floor is high enough that in almost any situation they can meet their financial goals and make it to and through retirement is far more important than shooting for the moon by concentrating in any one sector. The other question we've been getting lately around stocks is, Warren Buffett, the famous Oracle of Omaha, has been selling stocks. Should you follow his lead? And here we have just several examples of headlines from recent news stories about Warren Buffett selling. And the reality is to consider is two things. One is that we just talked about the concentration in tech stocks. The stock that Warren Buffett has mostly been selling is actually Apple, a darling of the tech industry. Not saying you should sell Apple, but just keep in perspective that the stock that Warren Buffett is selling is one of those large tech stocks. But I think much more importantly is the idea that your situation and your opportunity set is very, very different than Warren Buffett's. Berkshire Hathaway is one of the biggest companies on earth. There's only several dozen or maybe 100 stocks in the entire world they can buy that will make a difference. They only have a very narrow subset they can target, and maybe some of those stocks are expensive. As an individual, your opportunity set is much larger. You can buy big companies, you can buy small companies, you can buy growth stocks, you can buy value stocks. You can buy US stocks, international stocks. You can buy other asset classes that aren't available to somebody like Warren Buffett, and he's even alluded to this. He said he doesn't think he'll beat the S&P 500 or the market that much anymore just because size has become a hindrance. So are some stocks expensive? Yes, today some stocks are expensive, and that's true all the time. There's always stocks that are expensive. But there's also stocks that are much more fairly valued. Some of the small companies, some of the international markets are much closer to historical norms. So when you think about moving out of the market, you need to make sure that you're defining the market appropriately. Valuations across the broader market, in some cases are expensive, in some cases are more fair. You want to make sure you own a little bit of everything. The final question that we've been getting is people that are worried about the direction of the country, whether due to politics, the economy, et cetera, and asking, what should I do? And the first thing we say is a famous saying comes to mind of don't just do something, stand there. Many, many times the best thing you can do from a financial perspective is absolutely nothing. Obviously here at Pure Financial, we have our hands on the wheel. We're consistently looking at your cash flow to make sure your portfolio can withstand your future needs on your portfolio. We're looking at tax opportunities. We're rebalancing or tax managing the portfolio, looking for new investment opportunities. But the idea of making wholesale changes to your investments most of the time doesn't make sense. But if you do want to make changes, here are a couple things to consider. Add non-correlated assets to your investment mix. So we have opportunities around investments in some cases that maybe don't move exactly like stocks and bonds. And these opportunities, they're not right for everybody, some of these investments. It's case by case, and this is where talking to your financial advisor to see if you should sprinkle in something in addition to stocks and bonds can make sense, right? Sometimes individual securities, individual bonds, or individual stocks make sense rather than ETFs or mutual funds. We're product agnostic. We don't care if it's an ETF, a mutual fund, an individual stock or bond. It's what's the right tool for the right job. In some cases, having those individual bonds gives you certainty around when you're going to get your money back. Those individual stocks give you more tax loss harvesting opportunities if the market is volatile, which it always is. Even in an up market, you might be able to tax loss harvest. And so talk to your advisor about that. And then if you want to change your asset mix, do it in a measured way, if at all, right? Don't go from 100% stocks to zero. Go from 70% stocks to 60 or something like that. Make a small change. And most importantly, rerun your financial plan. The reason we start with the financial plan is because it's not about the portfolio. The portfolio matters. It's the engine for the car. But what really matters is, does your overall financial situation support your financial goals? And that's why we consistently review with all of our clients our financial plans. So again, today's video really intended just to give you some perspective on what the future may hold, and as well as recent events. If you have any questions on this or anything else, as always, please reach out to your financial advisor.